Hey investors, I hope you're doing well. Today we've got something special in store for you. We're going to dive deep into the world of undervalued dividend aristocrats, what they are, why they matter, and how they can potentially upgrade your investment portfolio. But first, let's break it down. What exactly is a dividend aristocrat? A dividend aristocrat is a name given only to a handful of stocks. These are companies that have not only paid their dividends consistently for decades, but have also increased those dividends for at least 25 consecutive years. It's like finding a reliable friend who keeps giving you bigger and bigger presents on your birthday. With this year's rally in the stock market, it keeps getting harder to find quality stocks at a good price. For this video, we've delved through many of the dividend aristocrats to find the ones that we think are most undervalued. But before we dive into the analysis, I'd love to know what dividend stocks you are currently buying. Let me know in the comments, and if you are new to the channel, on here we post content about dividend stocks and other analysis videos very regularly. So if you enjoyed this video, I would appreciate you liking the video. Let's get it started. The first dividend aristocrat of today is Automatic Data Processing. Automatic Data Processing is a global company that specializes in providing human resource management software and services. They offer a solution for payroll processing, employee benefits administration, talent management, and much more. ADP helps businesses streamline their HR processes and manage workforce-related tasks efficiently. If we look at the stock price performance over the past year, we can see that the stock is only up almost 4%, and year to date it's up 7.6%, with a massive rally in the past few months. It has dropped from January from $245 to around $210, but it has managed to regain a lot of momentum, going back to $255 that it is currently sitting at. If we look at a little bit longer time frame, we can see that in the past 5 years, the stock is up over 75%, and if we go back 10 years, it's up threefold. If we go check into their dividend statistics, we can see that in Seeking Alpha, it says they have 24 years of consecutive dividend growth, but they actually have 25 years, making them a dividend aristocrat. They currently offer you a starting yield of almost 2%, and their growth rate is very nice, with a 5-year average growth rate of just under 14%. And this with a payout ratio that is sitting slightly above 58%, which could indicate that they have more room left to increase their dividends further. If we look at this chart in their dividend history, we can see that they have increased their dividends a lot in the past 25 years pretty much, if it loads. Yeah, we can see that they have gone from around, let's go back into 2000s, we can see that they were paying 7 cents a share, which has gone up all the way to $1.25 a share, which is quite impressive. And if we go dive into the valuation of automatic data processing, first off we'll be using the discounted cash flow model. We've imported free cash flow of automatic data processing going from 2013 to 2022, and the average growth rate in this period has been sitting at just under 11%, and I'm projecting their future free cash flow to grow by around 10% on average. And with this percentage, we'll determine the future free cash flow for automatic data processing and determine its terminal valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $116.7 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of just over $115 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $280.30, which is almost a 10% upside out of this model. Moving on to the dividend discount model, if I zoom in a little bit, we can see that on average in the past 5 years, the dividend payments have been increased by 12.3%. And I'm projecting all of their future dividends to grow by around 7.5% on average. I'll once again be using a discount rate in this valuation of 8.5%, and this gives us a dividend discount model price per share of $537.50, which is an over 110% upside of this model. Then, checking out the Graham's revised valuation formula, we take a look at the earnings per share that automatic data processing is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And if we take account all of these metrics, we get a Graham's price per share of $155.04, which is a downside of 39.38%. Then moving on to the multiple valuation, we imported the stock price and earnings per share of 2 companies that are similar to ADP. And with this, we get the average PE multiple in the industry, which in this case is sitting at 24.25. And all that's left to do then to get our intrinsic value of this model is to multiply by the earnings per share that ADP is generating, which is $8.21 a share, giving us a multiple valuation price per share of just under $200, which is a 22.16% downside out of this model. And the last model that we'll check out for this valuation is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. We've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.05%, while the current yield is sitting at 1.96%, indicating that's slightly overvalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 29.38, while the current PE ratio is sitting at 31.16, indicating that you're paying more for their earnings in relation to the average of the past 5 years. Once again, indicating that it's overvalued on this metric as well. And out of this we then get an intrinsic value of $242.81, which is a 5% downside out of this model. If we go then to our final overview of our valuation, we can see we've imported all of the valuation models, and this gives us an average of $282.94, and we've determined a margin of safety of 5%, using a standard margin of safety of 25%, deducting it by 5% for the margin growth and the debt to EBITDA, and deducting it by 10% for the dividend growth, leaving us with a 5% margin of safety. Applying this margin of safety, we get a fair value of $269.47, and with the current price of $255.75, we get a small upside of 5.37%, indicating that's currently a slight buy. If you want to get access to all of the valuation models that I use in my videos, including this one, you can check out my Patreon link. By subscribing to my Patreon, you get a basic toolkit to get started on your valuating and investing journey. And in this toolkit, you get a basic portfolio tracker where you can track your stocks, your dividend income, and much more. And you get access to 2 stock valuation models that I use in all of my videos, including the dividend stock valuation and the non-dividend stock valuation. And if you go a little bit further and get the advanced assets toolkit, you also get everything, of course, in the previous tiers, and you get access to the REIT valuation models that I use and the financial and bank valuation models. And you get access to an advanced portfolio tracker, which gives you tons of more features than the basic portfolio tracker that we provide in the first bundle. And you can also track your stocks and your crypto in this portfolio tracker as well. Anyways, getting that self-promotion out of the way, let's go look at the next stock of today's video. Today's second stock is Chubb. Chubb is an insurance company that specializes in providing a wide range of insurance and risk management solutions. They offer coverage for individuals, businesses, and organizations, including property and casualty insurance, liability insurance, cybersecurity insurance, and much more. Chubb is known for its expertise in helping clients protect their assets and manage risks effectively. If we look at the price action of Chubb over the past year, we can see that the stock is up by almost 6%, but if we look on the year-to-date perspective, it's down by almost 8% on this time frame. If we look at a little bit of a longer time frame of 5 years, the stock is almost up by 50%, and looking back 10 years, the stock has gained 130.5%. If we look into their dividends a little bit, we can see that they currently offer a starting dividend yield of 1.69%. Their dividend growth rate in Seeking Alpha is actually indicated wrong, but they are indeed a Dividend Aristocrat, so don't be fooled by this. The 5-year average growth rate in their dividends has been sitting at 3.21%, and they have a low payout ratio of 20.24%. If we go look at the valuation model, we have imported the free cash flow for Chubb going from 2015 to 2022, which gives us an average growth rate of 18.36%. But I'm projecting no future growth in their free cash flow, and with this, of course, then we'll determine the future free cash flow for Chubb and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $161.9 billion, and to get our equity value, we have to add the cash and equivalent and subtract the debt, giving us an equity value of $155.9 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $379.54, which is an upside of almost 87%. Then looking at Graham's valuation, if I zoom in a little bit, we can see that the earnings per share that Chubb is generating is $13.91 a share, and growth rate estimate by Wall Street is sitting at 12.4. And if we look at the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, we can see with all of these metrics that the Graham's price per share out of this model is $254.80, which is an upside of over 25%. Then moving on to the multiple valuation, we have once again imported the stock price and earnings per share of 2 companies similar to Chubb. And then we get the PE multiple that is average in the industry, which in this case is sitting then at 14.83. Multiplying this by the earnings per share that job is generating gives us a price per share of $206.30, which is a small upside of 1.5%. The last model that we use in this valuation is the mean reversion theory. We of course now know how the mean reversion theory works, so we have imported the dividend yield of the past 5 years for Chubb. And on average it has been sitting at 1.93%, while the current yield is sitting at only 1.69%, indicating that's overvalued on this metric. Doing the same with the PE ratio, we can see that the average PE ratio in the past 5 years has been sitting at 15.52, while the current PE ratio is sitting at 14.62, indicating that's undervalued on this metric. Then we get a price per share out of this model of $196.99, which is a 3.10% downside out of this model. Then going to our final overview of our valuation, we've imported the valuation models and gotten an average price per share of $259.41. And we've determined the margin of safety earlier using the standard margin of safety of 25%, adding 5% for the margin growth, deducting 5% for the payout ratio, and 5% for the debt to EBITDA, leaving us with this 20% margin of safety. And when applied, we get a fair value of $216.17, which is a 6.34% upside from the current price of $203.29, indicating that Chubb is a slight buy as well. Let's go move on to the next stock of today's list. The next stock on today's list is Sherwin-Williams. Sherwin-Williams is a company known for manufacturing and selling paints, coatings, and related products. They serve a wide range of industries including construction, automotive, and consumer goods. Sherwin-Williams provides paint solutions for homes, businesses, and industrial applications, making them a leader player in the global paint and coatings industry. If we look at the year-to-date price performance, the company has been on a nice surge this year, with the stock being up almost 15%. If we look back a little bit further, let's say the 5-year time perspective, it's up almost 80%, and in the past 10 years it has done very well, with the company almost being a 4-bagger. If we look at the dividend statistics, the dividend growth rate has been very nice on this company, with 44 years of consecutive dividend growth. And their 5-year dividend growth rate has been very stunning as well, with an average growth rate in the past 5 years of 16.13%. And this with only a payout ratio of almost 24%, meaning that they have still a lot of room left to increase their dividends further. But they do offer a relatively low starting yield of only 0.88%. If we then go look at the valuation models, we have once again imported the free cash flow of Sherwin-Williams, and the average growth rate in their free cash flow annually during this period has been sitting at 10.65%, and I'm projecting their future free cash flow to grow by 17% annually, and with this percentage we'll determine the future free cash flow for Sherwin-Williams and determine the terminal year of valuation using the same perpetual growth rate of 3% and a discount rate of 8.5% in this one. This gives us a sum of free cash flow of just over $60 billion. And adding the cash and equivalents and subtracting the debt from this, we get an equity value of just over $48 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $187.16, which is almost a 32% downside from this model. Going to the discounted dividend model, we can see that we have imported the dividend payouts of Sherwin-Williams of the past 5 years, and on average they have grown their dividends by almost 13%. And I'm projecting all of their future dividends to grow by 8%, and we will once again be using a discount rate of 8.5% in this valuation. And this gives us a dividend discount model price per share of $522.72, which is an upside of over 90%. Moving on to Graham's valuation, we've imported the earnings per share of Sherwin-Williams and imported the growth rate estimate projected by Wall Street, and once again the same corporate bond statistics that we've used in the past valuations. And looking at all of these metrics, we then get a Graham's price per share out of this model of $153.13, which is an upside, well actually a downside, of 44.28% from the current price. If we then head over to the multiple valuation, in this case we've imported 3 similar companies to Sherwin-Williams. Import their stock price and their earnings per share, and this way we could determine the average PE multiple in the industry, which in this case was sitting at 33.40. And multiplying this by the earnings per share of Sherwin-Williams, we get a multiple valuation price per share of $300.90, which is an upside of almost 9.5%. And once again, the last valuation model that we'll be using for this company is the mean reversion theory. And on average, the dividend yield of the past 5 years has been sitting at 0.72%, while the current yield is sitting at 0.88%, indicating that's undervalued on this metric. Doing the same with the P/E ratio, the average P/E ratio of the past 5 years has been sitting at 32.60, while the current P/E ratio is sitting at 30.50, indicating that's slightly cheaper than its historical average, giving us a price per share out of this model of $314.34, which is an upside of 14% from the current price. If you then head over to the final overview of our valuation, we have imported once again all of the valuation models, giving us an average price per share of $295.65. And we have applied the 5% margin of safety that we have determined earlier, using the standard margin of safety of 25%, deducting by 5% for the margin growth, 10% for dividend growth, 5% for the payout ratio, adding 5% for the debt to EBITDA, and deducting it once again by 5% for the return on invested capital, leaving us with this very low 5% margin of safety. Applying this margin of safety, we get a fair value of $281.57, and with the current price of $274.82, we get an upside of just over 2%, indicating that's once again a small buy. The fourth company is Genuine Parts. Genuine Parts is a company that operates in the automotive and industrial parts distribution business. They distribute automotive replacement parts, industrial replacement parts, office products, and electrical materials. Genuine Parts Company is the parent company of NAPA Auto Parts, Motion Industries, and other subsidiaries, serving various markets with a focus on providing quality replacement parts and products. The stock has not been doing that great so far, with the stock almost being down 9% year to date. If we look back a little bit further, the stock on a 5-year perspective has been up by almost 55%, and looking back 10 years, the stock is up 95.7%. If we look a little bit into their dividends, we can see that they have an amazing dividend growth track record with 66 years of consecutive dividend growth rate, which is, I think, one of the greatest track records in dividend increases ever, honestly. And a 5-year average growth rate in the dividends has been sitting at 5.75%. And this is supported with a payout ratio at 41.65%. And they currently offer you a starting dividend yield of 2.45%, which is pretty nice. If we look at their valuation, we've imported once again the free cash flow of Genuine Parts, and this is an average growth rate of 26.25%, and we'll be projecting a growth rate of 10% in their future free cash flow, which gives us a sum of free cash flow of $37.1 billion, and gives us an equity value of $33.6 billion when we add the cash and equivalents and subtract the debt. Then dividing this equity value by the amount of shares outstanding, we get a discounted cash flow price per share of $239.26, which is an upside of over 54%. Looking at the discounted dividend model, the average growth rate in the dividends during this period has been sitting at 8%, and will project into the future with a growth rate in their future dividends of 6.5%, and once again using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $202.35, which is an upside of almost 30.5%. Going to the Graham's valuation model, we've imported the earnings per share of Genuine Parts and applied a growth rate estimate projected by Wall Street, which in this case is 9%. We've also, of course, taken into account the average yield of AAA corporate bonds and the current yield of AAA corporate bonds, and looking at all of these metrics, we get a Graham's price per share $129.32, which is a downside of 16.61%. Heading over to the multiple valuation, we've once again imported 3 companies and their stock price, earnings per share, giving us the PE multiple in the industry, which in this case is sitting at 22.76. Multiplying this by the earnings per share that GPC is generating gives us a price per share of $194.82, giving us an upside of this model of 25.63%. Looking at the last model of this valuation, we have the mean reversion theory once again, and we've imported the dividend yield of the past 5 years, which has been sitting at 2.73%, while the current yield is sitting at 2.45%, indicating that it's slightly overvalued in this metric. Doing the same with the PE ratio, the average PE ratio in the past 5 years has been sitting at 18.94, while the current PE ratio is sitting at 18.13, indicating that's slightly cheaper than its historical average, indicating that's slightly undervalued in this metric. This gives us a price per share out of this model of $150.54, which is almost a 3% downside out of this model. If we then look at the final overview of our valuation, we have once again imported the stock prices of all of the valuation models, giving us an average of $183.26. Applying the 10% margin of safety that we have determined earlier, we get a fair value of our models of $166.60. And with the current price of $155.08, we get an upside of 7.43%, indicating that's once again currently a buy. Let's go take a look at the final stock of today's video. And the last stock that we'll be looking at today is W.W. Grainger. W.W. Grainger is a company that specializes in industrial and maintenance supply distribution. They offer a vast catalog of products including tools, safety equipment, janitorial supplies, and much more, catering primarily to businesses and organizations. W.W. Grainger serves as a one-stop shop for customers seeking industrial and maintenance solutions, helping them maintain and operate their facilities efficiently. The stock has been on an absolute surge this year, with the stock being up almost 28% year to date. And if you look back a little bit further, it's looking very nice as well, with in the past 5 years almost sitting at a gain of 100%. And if you look back even further in the past 10 years, the stock is up by 175%. If we look into their dividends, we can see that they have recently become a dividend king with their 51 years of dividend increases consecutively. And their past 5-year average growth rate has been sitting at 6.28%, with only a payout ratio of 20.47%. And the starting yield that W.W. Grainger currently offers is 1.05%. If we head to the valuation model, we can see that the average growth rate in their free cash flow annually during the past 8 years has been sitting at 10.2%, and I'm projecting this growth rate to continue with an expected growth rate of 10% in their future annual free cash flow. And with this 10% will determine the future free cash flow for W.W. Grainger and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. And this leaves us with a sum of free cash flow of $32.2 billion. And then we get an equity value of just under $30 billion when we add the cash and equivalents and subtract the debt. And divide this equity value by the shares outstanding, we get a discounted cash flow price per share of $597.18, which is almost a 16% downside. Going over to the discounted dividend model, we can see that their average growth rate in the past 5 years has been sitting at 6.61%. And I'm projecting their future growth rate in their dividends to be around 7% because they have such a low payout ratio. I'll once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $530.72, which is a downside of over 25%. Looking then at Graham's revised valuation formula, we've imported the earnings per share of W.W. Grainger, the growth rate estimate projected by Wall Street, and the same statistics in the bonds that we've used in the previous valuations. This gives us a Graham's price per share of $1,154.34, which is an upside of over 62%, which is actually a rare sight for this valuation model, since it's usually very conservative and only gives small returns. If we then go over to the multiple valuation, we've imported 2 similar companies to W.W. Grainger and imported their stock price and their earnings per share, giving us the average P multiple in the industry of 26.93. Then multiplying this by the earnings per share that W.W. Grainger is generating, we get a price per share out of this model of $940.82, which is an upside of over 32% from the current price. If we then head over to the last valuation model of this valuation, we get the mean reversion theory, where we have imported the dividend yield of the past 5 years, which has been sitting at 1.56%, while the current dividend yield is sitting at 1.05%, indicating that's overvalued on this metric. Doing the same with the P/E ratio, on average it has been sitting at 23.41, while the current P/E ratio is sitting at 20.35, indicating that's undervalued on this metric. This gives us a price per share of $648.34, which is a downside of almost 9%. Then heading over to our final overview of evaluation, we have once again imported all of the valuations out of our valuation models. This gives us an average of $774.28. And we have determined our margin of safety before using a standard margin of safety of 25%, deducting by 5% for the margin growth, payout ratio, debt to EBITDA, and return on invested capital, leaving us with only a small margin of safety of 5%. This gives us then a fair value of $737.41. And with the current price of $710.78, we get a small upside of almost 4%, indicating that it's currently a buy rating from our valuation. And that wraps it up for today's video. I really hope you enjoyed watching. This video was a ton of fun to make, since these are all companies that I don't usually analyze. If you want to be notified whenever I upload, you can hit the subscribe button down below, and I'll see you on the next one. Thanks for watching.